Hello, I'm Hickey from interest.co.nz and welcome to a special report on the banks, brought to you in association with ASB. Late yesterday, a Parliamentary Committee, the Finance and Expenditure Committee, put out a report which is sharply critical of New Zealand's Australian-owned banks. It even made the front page of the New Zealand Herald this morning. Their criticisms are quite varied and quite sharp. They've come out and said that the banks have not cut their mortgage rates fast enough and as far as they could have given the fall in the official cash rate. They've also said that bank profits have not fallen fast enough and they expect them to do more, and that the Australian-owned banks here haven't supported New Zealand firms. Well, let's have a close look at each one of those claims and put them under the microscope. Because this is a parliamentary committee, it represents, in theory, New Zealand, and although it's not government policy, they've certainly caused quite a stir. Let's look at first whether the banks have passed on the official cash rate changes and whether they should. Let's have a look at the floating mortgage rate, which most people think moves in lockstep with the official cash rate, or at least something close to it. Back last year, the floating rates peaked at about 10.7%. Since then, they've fallen by 4.4% to around about just over 6%. The official cash rate, therefore, has fallen 5.75%, and floating mortgages are down only 4.4%. So there's about a 1.3% gap there, which you could argue the banks are pocketing. So surely that must mean the banks are making bigger profits because they haven't cut their mortgage rates as much as the official cash rate's cut. Well, let's have a close look at that, because banks don't only fund their mortgages from the official cash rate, they fund it from all sorts of places, including overseas and locally with term deposits. So let's have a look at that term deposit market. Because one of the complaints many people have about banks is that when the official cash rate drops, banks cut their term deposits much faster than their mortgage rates. In fact, they cut them much further and pocket the difference. Well, actually this time around, that's not clear at all. We've seen the term deposit rate fall by about 4.5% to 3.9% in the last 6 months or so. That means the gap, so the difference between term deposit rates back then and what they are now, is actually quite high compared to the official cash rate. You're actually getting 1.4% more for the official cash rate if you save on a 6-term deposit than you did quite some time ago, back at the beginning of last year. So all of this means that the banks have had to fight hard for those term deposits and offer quite high prices. Meanwhile, the banks have also got $100 billion in borrowing offshore, which they need to pay interest costs on, and those interest costs have increased. We've seen the gap at around about 1.7%. Now, that's a lot of numbers. It's worth having a look at what does it mean for the bank profits. And is it easy to throw around lines like the banks make more than $3 billion in profit and it's too much, and that those profits have been rising. Well, actually, they haven't. Let's have a look at what the banks have actually reported in the 6 months to the end of March. Remember, the Finance and Expenditure Select Committee were looking at numbers up to the end of December. And the Reserve Bank hadn't looked at those March figures when it told the committee that the bank's profits were up. Actually, bank profits have fallen sharply in the March quarter. Let's have a look at those numbers. And I've gone through the statements from the banks and worked out what's happening there. Firstly, all 4 of the big banks reported falls in their net profits. And the average fall was around about 18 to 20%. So that's a significant fall in profit, particularly for such big companies. Also, 3 out of 4 of the banks reported lower net interest margins. Now, the net interest margin is the best way to measure how much money the banks are making by charging out on interest and the difference on what they pay back in interest to those people who've got savings with them. So, 3 out of the 4 saw reductions in their net interest margins. ASB, for example, its net profit fell 26%, BNZ's profit fell 4%, ANZ National's profit fell 29%, Westpac's profit fell 15%. So there's a question there. Have the bank profits fallen enough? Well, they've fallen at least 20%. There's a question there too, do you want your bank's profits to fall an awful lot? Because the more bank profits fall, the more riskier they are, and the less likely they are to keep growing lending. That brings us to the second point. Have New Zealand's banks kept lending to New Zealand businesses and to consumers through the tough period of the recession? Remember, one of the complaints that the Finance and Expenditure Select Committee had was that the banks hadn't really supported New Zealand through this period. Well, actually, let's look at the numbers from the Reserve Bank, which show that business lending rose 6.8% in the last year. Farming lending rose 21% in the last year. Housing lending up 2.6%. So overall, lending by the banks to New Zealanders, consumers, those in housing and farming, has risen substantially in the last year. Contrast that with what you're seeing overseas. Not in Australia, we're talking the UK and the US and in parts of continental Europe. Their lending has dropped 20%. There we have it. A rebuttal, if you like, to the Finance and Expenditure Committee report into bank profits and bank margins. I'm Bernard Hickey. That was a special report brought to you in association with ASB.